hello everyone. Welcome to this webinar today. My name is Ali. I'm VP of Market Analysis and Education in Inveslo, and in this webinar we are going to talk about the different types of Inveslo orders. I hope you found it joyful and also informative because we are going to introduce the very common ways that the professional traders usually used to place their orders. But before we just jump on our agenda for today, please take into your consideration that all the content that we are providing during our webinars are just only for educational purposes, and all the content mentioned in the webinar do not constitute investment or trading advice. You will find out why education is really matter to everyone who wishes to be a successful trader, because during this webinar you will see we are going to talk about some details about the trading that's usually overlooked by most of the brokers or those gurus that are just talking about the market strategies and everything. But you will find out why we are saying all the time that the education is the most important part and the cornerstone of being a successful trader. Okay, here is our agenda for today. We will talk about the types of execution. We'll see how actually orders are going to be executed by the broker, because the Forex is an OTC market. It means there is no central location, and this is an electronic network filled by brokers, dealers, and traders. So the way that the orders or the trades are executed, and then we will walk through some pending orders and instant orders, and we will introduce you to the buy limit and sell limit. Those are very interesting trading strategies that you can use them in a different trading setups. And also we'll talk about the buy stop and sell stop, and during this session we'll have an open Q&A, and you can just send your question through the question tab, and all of your comments would be very welcome, and I would get back to them at the end of the webinar. So let's start to see what is the execution or trade execution in Forex. In trading, execution is completion of a buy or sell order from a trader is carried out by a broker. Okay, and when you put in a request to purchase or sell an asset, that order goes into a handling framework. However, you have the freedom to choose the way in which your order is processed based on the price you choose to trade at. And you can execute your trade at market prices via market execution, and or using the instant execution. Those are placing orders or placing trades based on the current market price, or moreover, you have the option to use a predetermined prices to place a trade in future when you wish the price reach some specific levels. If you know how to place your order, that would be very helpful to accompany this with your trading strategy. So now there are more than one way to execute a trade. Okay, so let's talk about the orders that we can place based on the current market price. There are two types of orders that you might notice on your MT4 platform. One of them is instant execution, and the other one is the market execution. There are differences between them. Let's start with the instant execution. Instant execution is a method by which brokers execute orders at the trader's requested price. In other words, if I want to explain it in a better way, if the price of an instrument changes as you place an order, the broker will send you a notification to confirm you agree to the newly changed price. It means instant execution. For example, when you refer to the MetaTrader 4 and you want to place a new order through the new order tab here on the main menu, you may see this window pops up, and then here is a type of order that you can choose: instant execution and pending order. When you choose the instant execution, you mean you wish to open a trade at a very specified market price. For example, you see here the current price, for example, here, this is for buy and this is for sell. As you see here, this is an ask price and this is a bid price, and we know always the ask price is higher than the bid price. So when you want to open a position based on the instant execution, it means you're going to choose the current price of, for example, of this price to sell or this price to buy. Let's say I'm going to buy a determined on a determined volume as a 0.01 a lot of this instrument CHFJPY or something. And if I actually, when I use the instant execution, if I click on the buy, my position will be opened on this price at the moment. Okay, so we use instant execution only when we want a very specified price to get into the market. Otherwise, we can use the faster one, which is the market execution. So there is a risk involved with the instant execution that we call it a requote. What is the requote? It means when you use the instant execution, it means you actually put your attention on the specified price level. Okay, so if at that moment that you are going to open your position or place your trade, if in that moment that price level wasn't existed in the market, the broker will send you a notification that your specified price is not available right now, and we call it the requote. Okay, because the broker wants to check with you are agree to change your price. Otherwise, the broker will not open that position for you. And other than instant execution, there is another way of execution at current price, which is called market execution. When you put a request to purchase or sell an asset, that order goes into a handling framework, as I said. However, market execution is a method by which traders execute orders at the current price within fractions of a second. This is the fastest way to execute a trade. You want your position to be opened as soon as possible at the moment, so you can place an order at any exact price, but the broker sees in that way that you prefer to open your position as soon as possible. So the broker will execute your trade at the nearest price available in the market at that moment. It means there is no requote for market execution, and most of the ECN accounts come with the market execution. For example, here you see my demo account is the standard account, so I have only one option available here as the instant execution for my current let's say market executions. But if I choose a different account, like one types of ECNs, you may see that I have another option as well. Yes, I guess this is the, let me check if this is the right one. Yeah, this is my demo ECN account, and when you want to place an order here, you see the type of the order has changed to market execution. And the market execution, as I explained, is the way of processing or executing your trade based on the nearest available price into the market as soon as possible. So if you want to open your trade at the moment as fast as possible, you can use the market execution, because in that case, broker will search among all the available prices in the market to cover your position, and then your position will be executed maybe with a fractional difference from the exact price that you wanted to open your position. But the bright side is that your position will actually get opened as soon as possible. But if you prefer to open your position on a very specified price based on your calculation, your strategy, or anything, you can use the instant execution, which means you want to take care of the price that you are going to enter the market, because maybe higher or lower than that price would not suitable or preferable for you. Okay, so besides all this trade execution, we have also the pending orders. And pending orders allow investors to buy and sell securities at a certain price in the future. So this type of order is used to execute a trade if a price reaches a predefined level. And the order will not be filled in if the price does not reach that level. In effect, we have two kinds of pending orders: the stop orders and limit orders. And so we will go through them and see more details about them and learn how they actually differ each other and how we can use them for a very specific trading strategies. And this is the most common way that the most actually professional traders, for example, day traders or swing traders, usually use the pending orders, because it is very recommended that you should enter the market in a very prepared level, because you have to have your stop loss, take profit, entry triggers in your mind. And then based on all of those calculations, you have to enter the market. So when you are a professional trader, you are taking care a lot of your money, and you really don't want to lose your money before you want to gain from the price fluctuations. Okay, in that manner, the pending orders are very helpful for us, because we can use them to set the stage for placing a trade. Okay, pending orders are broken down to stop orders and limit orders. Let's see what is the buy stop order. And we have the buy orders and sell orders for each type. And so let's see what is a buy stop order. Okay, a buy stop order instructs a broker to purchase a security when it reaches a pre-specified higher price than the current market price. For example, you see after this large drop to this level, market actually topped here, and then you may consider it as immediate resistance level, and then you may assume if price reaches this level again, there might be the trigger for beginning a new uptrend. Because we know, based on the theory, for a downtrend, we need actually the successive lower tops and lower bottoms. So in the event that this last top here is broken, it means we are at the end stage of our prior downtrend. It means that would be a reversal for us, maybe an opportunity to place a buy trade. But right now, price is here, so we can't be sure about that. We have to wait, but we really don't want to miss the chance to get into the market at this level, because we assume it might be a very, very nice buy opportunity there. So in that case, we can place our buy stop order at this level. And as soon as the market reaches this level, our position will be executed, or our trade will be executed, and our position will be opened by brokers. So in that case, we can actually make sure that we are not going to miss this buy opportunity if it's going to be a reversal setup. And also at the same time, we can just determine our stop loss and our take profit levels. And then you may see here, as soon as the price reaches this level, our buy position will be opened, and then when we put our TP, we are going to gain some money at this level, and our position will get closed here. So this is the buy stop order. And let's see, what is the sell stop order? The sell stop order is something just the same, the opposite direction. A sell stop order is a stop order used when selling. When we wish to sell or open a sell position, it includes a stop price that then triggers the allowance of market orders. Sell stop orders have a specified stop price in the case of a sell stop order, and you can specify a predetermined price lower than the current market price when it comes to open sell stop order. For example, here you see the market is in a pure range bound or sideways, and you may assume if the market just breaks below this last bottom here, or this range support here, it might be a trigger for a new downtrend. So you want to set the stage to open a sell position, but right here at this current level, you are not sure if the price is gonna break this level. Okay, so you can consider this solid, this actually range support here, and you may place your sell stop order a bit below this level to be sure if the market just breaks below this important support level, then there might be emerging new downtrend in the market. So you can choose it as an entry or with a buffer lower, and you can put your stop loss at the some level at the previous actually market top, and then also you can determine your take profit. This is the proper way to place a sell stop order or any types of order. You have to know your stop loss and also your take profit based on your risk ratio and risk management rules, and then you see as soon as the market, for example, reach this level, very large falling or decline occurs, and then it means you can gain some money. And in the case of opening the sell stop orders or buy stop orders, you don't need to check the market all the time. It means you can just look at the chart. Based on your trading strategy, you can choose your actual levels that they mostly better put them on the solid resistances or supports, and then you can just set the stage to take the most probable scenario and make some gains. Here are some points that might be useful when it comes to trade based on the stop orders. The first thing is that we are going to buy an instrument at a higher price for less risk. Concept of buying and selling is that buy an instrument at the lowest level and sell at the highest level, okay? But sometimes it's not possible to determine the exact high or low of the market, but we can gather some evidence and put them together and assume and make some theories, or let's say the probable scenarios based on your trading strategies. And then you can come with this idea that if the market is gonna start a new uptrend, so some important resistance levels should be broken. Okay, so it's better to put a buy stop order a bit above those important resistances. Or you may come to this idea that if the market is going to establish a new downtrend, so in your sell scenario or your bearish scenario, you can determine some significant support levels, and then you can put your sell stop order a bit below those significant supports to wish to open a trade, a sell position, as soon as the market actually breaks below those support levels. So this is a very suitable trading strategy for pattern recognition, especially reversals and breakouts. It means it's a very common way to trade reversals. Most professional traders use a stop order to trade the reversals. For example, here on the market, let's go through some common instrument like maybe Euro USD on a lower time frame, for example, 15 minutes. And today most of the world are closed. Markets are closed because of the Good Friday, and everyone happy Good Friday. However, you can see there's not too much actually fluctuation in the market right now. But for example, here you can see something like an ascending channel or something here. Okay, so you may think if the market goes above this level as the last top in the market and past this level as well, then there will be a chance to have a probable upside swing, or let's say upward movement. Okay, so if you actually can conclude your analysis based on this theory or based on this view, so you can go to place a buy or buy a stop order some actually a bit some pips above this level or above this actually ascending channel resistance, dynamic resistance here. Okay, for example, if I wanted to do that, I would go through the new orders and then I would choose a pending order, and here you have the option to choose between the limits orders and stop orders. And now we think the most probable scenario will be the bullish scenario, let's say, just as example. So we can choose the buy stop, and here you have to determine your price. For example, let's say the resistance level that I can see here is the one 0.08225 I would go with the, for example, 2235. Yeah, 8235. Okay, for example, there's some buffer above that, maybe, or even higher, depends on it's just on your call. And then also you have the option to choose the expiry, and it means you want this trade if the market reaches this level today or tomorrow or at the any other days. For example, maybe you see that eventually there might be the upside movement in the Euro USD, for example. So you may see, okay, let's just use this buy stop order to place a trade, to place an order with no expiry date, because maybe today, maybe tomorrow, maybe another week, you want to wait until this level reached by the market, and you can use it when you are certainly sure that the market is going to actually keep going up after reaching these higher prices. Okay, by the way, there is no limitation to put your stop loss, for example, here 0.08035, and also you can have your proper take profit somewhere here, let's say maybe somewhere here near this important resistance level at 1.08336. Okay, in that case you can place your order, and let's see what happened. Here is my predetermined price level to open a buy position as soon as the market reaches this level. And here, if the market reached this level and my buy stop order executed, then I would have this level as my stop loss, as you can see here, and this level as my take profit. Okay, so this is a very common way to trade this kind of breakouts. Or maybe, let me show you, for example, an historical data. For example, here you see a very range-bound shopping market has been here, and then prices just broke above this important resistance level here. And some traders might see this fail and this price rejection from the buyers with these shadows, and then they assumed that if market can reach above this level, so there will be a new buy opportunity there. So they in that case also you can just use these buy stop orders, and vice versa. You can use also all of those sell stop orders as well when you wish the market breaks below some important support levels. For example, you can see here, and this is a very common way to hunt the market reversals. You know, for example, after this beautiful uptrend here, making higher highs and higher lows, and then you see the market is getting stuck in this range right here and right here. Okay, and for example, somewhere after seeing this a bit lower top than the previous one, you can say that the market is out of this uptrend is out of steam. So you may wish to open a sell position at the best level to get the most probable actually bearish scenario here. You may determine the reversal will occur on the chart if the price breaks below the previous bottom here. for example, and then you can give it some buffer here and you can place your sell stop order, because it means at the lower price than the current market price. It means you assume the market will fall to this level, and if that happens, it means the market is going to establish a new downtrend here. So you are going to place your stop order, your sell stop order. So this is a very common way to trade reversals and breakouts, and also it's very useful to for this the pattern recognition. But one step forward, we have the limit orders, and let's go through the buy limit order. The buy limit order is an order to purchase a security at or below a specified price. It means if you can just identify the right market direction to stand at the right side of the market, you can wish to buy at the lowest level and sell at the highest level by using the limit orders. And buy limit orders is designed to get you to the lowest level that you think is lower than the current market price, and that level, the downward movement or price falling will be limited by the market. So that would be lowest low or lowest bottom of the market. For example, here you see a range bound in the market, and you may consider this level as significant support level, as you see the market bounced once, pulling back from this level once, and for the second time. So you can consider it as, let's say, the reliable support level. And you may assume that the price may drop to this level again, and then there will be a rebound from this level pulling up, okay? In that case, you wish to buy at the lowest level as possible. So you can consider this level as your entry to put your buy limit order here by this assumption that the price can't break this level based on some fundamental analysis or technical analysis or everything. But this is the ability that the market execution and limit orders give you to choose your predetermined lower price to open a buy limit order. It means you can design and register your buy limit order when you see the prices here and you assume there might be a downtrend, a downward movement through this level. So you can choose this level as your predetermined entry for buy limit order, and then if market reaches this level, your buy position will be executed, and you can use it only when you think the market is gonna bounce back from this level, pulling up after hitting this important support level. So to use the buy limit orders, you can go through the price chart and try to find out the solid support levels, okay? And then you can just assess that support levels and put your buy limit order maybe with a buffer above or below this entry point. Okay, in that case, you see after hitting this level, the market just pulled back, and then this became the lowest level, and that's a very great opportunity and good risk to reward ratio for opening a buy position. Also, we have the sell limit order, and a sell limit order is a way to sell an instrument at the price higher than the current price, following this idea that they sell at the highest and buy at the lowest level. So it means when you assume the market will reach a higher level before falling or continue the downward movement, so you are going to place your sell trade at that level, at the level higher than the current market price. For example, here you see in the chart, we have some range bound, and this is a top and this is the lower top, and we may consider this level as solid resistance level. And then you may assume if market reaches this level, there is no chance for the price to get above this, and that would be a very great opportunity with a low risk to reward ratio to sell the market, because you have a sell scenario in your mind and wish the price actually just bounce back and continue falling. So in that case, you can choose this level as your predetermined entry for a sell limit order. And then you see at the moment that the price reaches this level, your sell limit order will be executed. So you will not enter the market until the price reaches this level as your predetermined price entry. Okay, so after that, when price reaches this level, then your sell position will be executed, and it means if the price continue to bounce back, you will gain some profit. As you can see here, that happened just after reaching this level again as solid resistance level. And on the MT4, you can just use the same way to open those to limit orders. For example, you can go through the new order here, click on it by right clicking on any of these instruments, for example, and choosing the new order, and this window will pop up, and then you can choose pending order, and here you have the buy limit option and sell limit option. So we are going to use the buy limit when we assume that a resistance, that a support level gonna hold the downtrend, and that would be the beginning of a new upward movement in a large picture. So we really don't want to miss that buying opportunity at the lowest level that the market will provide us, will offer us. So we can use the buy limit, and we can use the sell limit when we wish to open the price at the highest level as possible at a rebound from the very solid resistance level. That would be the highest level to open a sell position. And likewise, you can just choose a pending order. You can just choose the buy limit or sell limit, and then you can put your price. This is a predetermined price. If you open a buy limit, it should be lower than the current price, and if you are going to open a sell limit, it should be higher than the current price. Okay, so and after that, you can place your order here, and as soon as the market reaches that level, that predetermined, your position will be executed. There are some tips about the limit orders, as I mentioned, buy at the lower price with higher risk. The risk of opening position using the limit orders is higher than the stop orders, because you have to have a very great, or let's say very reliable evidences that make you sure, those evidences make you sure that those levels gonna halt the prior uptrend or downtrend that exists in the market right now, the current level. So it's a bit risky, but the point that you will get entering to the market will be a very, very nice higher level, the highest level for the sell positions and the lowest level for the buy position. And this is a very suitable strategy for rebound trading. It means when you wish the market just continue swinging in a channel, or for example in a range bound tangle or something like that, you can use the limit orders at the predetermined trend lines or the channel support and resistance edges. Okay, and this is a common way to trade significant levels, as it when you consider some support and resistances in the market that you think there is no way for the market to break them. Okay, so in that case, you can just put the sell limit orders on or buy limit orders on that level. If there is a solid resistance level, you can put a sell limit order, because you know that resistance gonna hold this upward movement, and the buyers are gonna fail to reach above that significant resistance level. Then you want to be the first jumping and selling that instrument, and vice versa. You can open the buy limit order. You can when you consider a very solid support level going to be held by the buyers. So you may see the market is falling, but you assume that they can't break below that important support level, so there might gonna be a rebound, pulling back or pullback from that level. So you will be able to put your buy limit order there at the solid support levels. Okay, I think that will be enough for today, and If you have any question, please write it down through the comments and I will back to you with the answers just after this webinar. Great. Thank you so much, everyone. Thank you so much for joining me on this Friday, and I wish you a very happy weekend. And also, I hope to see you next time.